following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
Mark Longo here from the Options Insider Radio Network and the optionsinsider.com, and I'm breaking in to your regularly scheduled program to give you guys an update on our Options Insider educational series. Now, a lot of you guys have been asking us when we're going to do something else like our groundbreaking unusual activity forum that we held back in May at the CBOE. Well, mark your calendars for December 7th because we're diving right back into the educational fray with an epic event on that Saturday, December 7th. We're going to break down the retail options trading landscape with 3 seminars held in partnership with our friends over there at optionpit.com. We'll break down the key mistakes that cost retail traders real money in the real trading marketplace, as well as how to properly implement and manage and adjust some really critical strategies like debit spreads, credit spreads, collars, risk reversals, butterflies, covered calls, the whole 9 yards. And best of all, this is going to be an online event, so you can join us from the comfort of your own home in your favorite bunny slippers. Don't miss this epic educational extravaganza with 3 seminars from 3 of the leading names in the business. Reserve your seat today at theoptionsinsider.com/events. And now I'll return you to your regularly scheduled program.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp, brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, everybody, those marching boots and that rocking tune means that it is time once again for your favorite educational options program, Options Bootcamp. This is, of course, the program where we take the raw retail options recruit such as yourself and proceed to break you down through a horrific and painful process, and then proceed to rebuild you slowly over time into a seasoned options veteran. My name is Mark Longo from the optionsinsider.com, as well as from a little thing we like to call around here the old Options Insider Radio Network. And I am joined, as always, by my stalwart companions, my partners in crime, the collective yin, or yins plural, I'm not sure what that is, to my yang, starting off with the man with the black hat, a.k.a. the prima donna belladonna, none other than good old Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the program, sir.
Buongiorno, paisan.
You sound like you've had a few cases of Chianti yourself. Big night in the Market Taker household, hey? We are also joined, beaming in all the way from scenic, lovely New York City, and it is getting to be that time of year when New York City certainly does get that nice holiday sheen to it. None other than Mr. John Critchley, the options major domo over there at sogotrade.com. Mr. C, welcome back to the program, sir.
Hi, folks. How's everybody today? We got a wonderful show planned for you guys. Great topic, a lot of insight, and I'm looking forward to it.
And I think without further ado, we'll kick things off with our basic training segment.
time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir! You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir! Call in. Prepare to learn. Yes, sir!
All right, everybody, welcome to the basic training segment. This is, of course, the portion of the program where we break down some interesting basic options concepts for you, the retail options trader, and then help you implement them into your trading and your portfolio. And today, we were kicking around some topics and what we thought we should talk about on today's show. And then Dan, in the midst of a Chianti frenzy, came up with a brilliant idea. He said, what about... because all three of us were market makers and members of the different exchanges on the trading floor at different times. We thought, what about lessons from that experience, lessons from the trading floor? Because we've said it a number of times on this show, and you know that way of life, that training period really is kind of going the way of the dodo now. And in many ways, technology has brought that about, and there's been a lot of great things for you, the end options user. Your ease of access to exchanges has improved, your speed of transactions, your transaction costs, as witnessed by Sogo. Look what those guys are charging you for your options trade. That would have been unheard of 5 or 10 years ago. So a lot of these improvements have been beneficial to you, the end user. But one of the downsides of that is it has been slowly eliminating that path that Dan and John and myself all took into this business, which is the market maker path. And what's really sad about that is, at the end of the day, there really was no better way to learn options. And, you know, it kind of is analogous to learning a foreign language. People always say the best way to, let's say, learn Italian is just to move to Italy and immerse yourself. Well, that's kind of what the market making route really was. You jumped into a pit somewhere and you kind of learned by doing. And some firm took you under their wing and they paid capital and resources to train you, and they stuck you in this environment and you kind of sank or swam. That was pretty much it. So by doing that, and also by the sheer act of doing it, because you weren't putting on positions so much as managing what people were throwing at you all day long. I didn't go down to the trading floor, and John and Dan didn't either, and say, gee, I want to get really long DSVOL today. You know, maybe later you did that, but pretty much the goal of the business was not to do that. You came in, and whatever paper dealt you that day, that was really what you dealt with, and you learned, because you put on these positions that you didn't really want, you learned how to manage them and spread them off in a very effective way. And so one of the downsides really of seeing that way of that business, that side of the business, I should say, really dwindling, is that fewer people have access to that expert high-end level of training. Well, thankfully, you have 3 people here on the show who've gone through that. We felt that pain, so you don't have to. And we thought, what better thing to do today than to try to impart some of those lessons. So I'm going to kick things off with some of our lessons from the trading floor. I could see Dan and John both clenching their jaws. I can hear them in my writing furious notes. They're ready to go next. They're champing at the bit. So I'll give them a couple of seconds to mull over what they want to say. And I'll kick things off with probably the number one lesson that was kind of hardest for me to really wrap my head around down there. Because you go down into any trading environment with some presupposed assumptions about what's going to go on in the marketplace. You think, well, paper's going to buy this. You think customers are going to sell this. I think the volatility level should be here. I think the term structure should be X. I think the skew should be Y. And then what happens is you go into the marketplace with those assumptions, and the marketplace proceeds to dash those all to pieces. And that was probably my earliest lesson that I had to really come to grips with, let's say when I was in the SPX pit, which is, of course, the institutional-sized product, the S&P 500 product that trades over in the CBOE. You'd have a perception of where I think, let's say, the August volatility should be trading in relation to June or in relation to March. And you would have this perception, or you'd have this perception of where a month should be just in general. I think this month really should be around here from a volatility perspective. Remember, as a market maker, we really were volatility traders, and we were more concerned with volatility levels than we were just about anything else. So deltas, other things, they weren't as big of a focus for us as the main Greek, Vega, and volatility. So that was kind of how we gauged the market. And what would often happen is you come in, you'd set what you said were your levels for the day. You say, okay, I think this month is around here. I think the skew looks like this. I think this is what this month looks like. And you'd go down to the floor and you'd be prepared to make your markets around those levels. And what would always happen is customers would come in and start trading. That's the nature of the game, and that's what we called on the show in the past paper flow. And what I learned very quickly is that paper flow really is the name of the game. Paper flow is the master to which all other things are beholden. You could sit there all day and make all the coherent arguments you want for why the implied vol in June should be X, and you could be completely right. And you could be dead set in that belief, and you could be refusing to adjust it. And yet customers in mass could be coming in and selling that month and crushing that volatility level and crushing that volatility level and crushing that volatility level. And I would see a lot of guys do this around me. They would say, wait a minute, I know this is illusory. This is just kind of short-term paper. This vol is going to come back up. I'm going to refuse to adjust my levels in my own positions to make them essentially even with the marketplace because I know it's going to come back. They also didn't want to do it, quite frankly, listeners, because they were long a lot of volatility, and adjusting it down would have cost them money. And they didn't want to make that realization or go home and go upstairs and hear from their risk manager, why did you just lose a bunch of money in X? So there was that motivation as well. But what we saw is that people over time, all of them eventually got brought to the dark side, and they realized what the market was doing. It didn't always make sense, and it didn't have to make sense. And that was probably my biggest thing. I say, why are they selling this? Why are they buying this? And we start digging into the weeds of that paper flow. Oftentimes, it didn't really make a lot of sense, and yet that was where the marketplace was. And so being able to adjust to that was probably my first big lesson. The paper flow is going to dictate what occurs in your product, and your own deeply held beliefs and views are almost immaterial. And for a lot of you out there, retail listeners who are trading on much smaller size even than we used to do on the trading floor, your net impact on your product is even that much smaller. So if you're going to go in and think, like someone I think wrote in on our last show and said, hey, can I bid up this skew if it's underpriced, your impact is going to be essentially negligible. So to go in there and think, well, I'm going to carve a line in the sand and refuse to adjust based on what paper flow is doing because I think it's going to come back my way, that's really just a road to ruin. And professionals over time really learn that the key skill is adjusting. And once you have something on, you see it's not going your way, and it's probably not going to go your way, and paper continues to do what you think it shouldn't be or what you don't want them to do, clearly there's other forces at work in the marketplace, and you need to become aware and respond to that. So there was number one lesson I learned that took me the longest time to do, really was that lesson. That paper flow dictates how your product performs, how it looks, how it shapes up in the marketplace. Everything else, analysis, skew graphs, volatility charts, all sorts of quant models, all that stuff goes out the window compared to what the customers are actually doing. So if you're in a product and you're like, why? Why is this skew doing this? Or why is this product doing this? Why is the vol doing this? It's the paper flow. And the sooner you can wrap your head around that and be able to adjust accordingly, the happier and more successful as a trader you will be. All right. And Mr. Passarelli, you've had enough time in your cup, sir. It's time to put them down and dispense some wit and wisdom to our listeners. And, of course, you do a lot of mentoring and education over there, so I'm sure you spend a lot of time doing exactly this, which is imparting the lessons you learned on the trading floor. And I would say, in general, all the time you spent down there talking to different market makers and traders and risk managers and whatnot, what would you say, if you had to impart to our listeners right now, the best advice that you heard or were given down there that was the most effective, had the most impact on your trading? What would you say that was?
Geez, I'll tell you, I acquired a pretty good slew of nuggets of good advice and could probably go in a number of different directions here, but probably the one that's most relevant to the people listening to our show is one that I talk to my students all the time, and I relate this story all the time, and if I've related it here on Bootcamp and you've heard it before, I apologize, but it's really, really sound advice and really, really makes a ton of sense. And that is when I was a clerk on the trading floor, and I'd been a clerk for a few years, and I was kind of at the crossroads where I was trying to decide what to do with the rest of my life.
So that was 1928, correct? About 50 years for the creation of listed options?
Indeed. And what I did is I went and asked a trader that I know. I said, well, what does it take to be a successful trader? And he said, well, you have to be really good at losing money. And that one didn't make any sense to me at the time. I just thought he was crazy. But it makes a ton of sense, because that's one of the big mistakes I see a lot of, especially new retail traders, novice retail traders, is you buy a call or something and the stock goes against you, it goes down, and time's passing, you're losing money, and you say, oh no, well, you know what, I'll just wait it out. The next thing it goes down further, and you try and wait it out a little bit more and it goes down further. Or even worse than that, novice option traders who prior to their career as a novice option trader were buy and hold stock investors, they say, well, what I always did when I was investing in stocks is I would just average price. If I bought some shares of XYZ company because I thought it was a solid company and the stock fell, I'd just buy more, because then I own the shares at a lower price. And that does not work at all with options. So I think that's probably one of the best bits of advice that I got. I mean, no, I imagine I could probably come up with about 10 more pretty good nuggets, but we have some time. Just take small losses, because otherwise they're going to end up being big losses.
Well said, sir. Well said. Good advice for everyone to take to heart. Now, Mr. Critchley, I can hear you furiously writing away. I know you have a lot you want to dive in and impart to our listeners. And I think your first nugget is kind of a corollary to kind of what I was saying about paper flow really being the dictator of all in the marketplace. So why don't you go ahead and impart your first bit of wisdom to our listeners, Mr. C.
One of my main takeaways from the floor from all the years, and one of the first things I learned was you can't fight the tape, and really you're never bigger in the marketplace. No matter how much, as a trader, at one point I had some money, I had some people behind me, firm, but you can never be bigger in the marketplace. So never try to prop up your positions. If you're a retail trader, you have a lot of money, and you're trading on illiquid options, even so, never try to prop up your positions by foolishly adding to them to support them solely because the position has gone against you. Let the marketplace take the options where they're going to be. Let them find an equilibrium, because if you don't, you're just going to keep doubling down. And my worst time, or my biggest losses, always came when I got stubborn. And Mark hit it on it right in the beginning. I thought I was smart in the marketplace. The vol should be here. They should be priced this place, and I own them. Now they're going lower. I'm going to buy some more. I'm going to prop them up. And then you just get hurt because you can never fight the street. It's just bigger than you are. So let the marketplace dictate where the options are going to go. And if you're wrong, take your losses. Dan hit on a lot of great advice that we'll hit on later in the show. But my number one is you're never bigger in the marketplace, and you can't fight the tape.
Dan, your little nugget there made me think of a pearl of wisdom that I first heard when I walked on the floor as well. And at first I thought it was people just being generally cranky, as they tend to be in that environment, and not exactly, given the time of day to a young little upstart clerk and trader. But you go down to the floor, and I walked onto the trading floor, having graduated and studying finance and derivatives and having all these grandiose ideas about how the marketplace worked and what caused this to happen. And then I would go down and I would say walk past the IBM pit, and I would see it's down 4% that day, and I would start scratching, my brain and say, wow, what is it down so much for? As an analyst, a recommendation, and I would talk to the guys in the pit and say, hey, what's going on? Why is your product down so much today or up so much today? Why is it moving? And the answer I would overwhelmingly receive was, more sellers than buyers, kid, or, more buyers than sellers, kid. And at first I thought they were kind of just being obnoxious, which I'm sure some of them were. But eventually over time, I started to see the wisdom in that. And that really, I think, kind of harkens back a little bit to that market maker mentality I was talking about earlier that you really have to have drilled into you over time. Is why that is occurring is almost immaterial. And if you spend a lot of time really, really getting into why this name is selling off X percent, you're going to miss what's actually going on that's important in the options market, which is how you adjust to it, what's going on with volatility, how you can deal with that, spread off that risk, and maybe put on another trade to take advantage of this. So that wasn't something I planned on talking about, but something you just kind of mentioned. Maybe think about it there, Dan, that, that little bit of wisdom has stuck with me for a long time. Now, a lot of the listeners out there, they get into a lot of other things that they think may move the market, technical analysis, fundamental analysis. All that stuff has its place. If you like it and you find it useful to you, then more power to you. But at the end of the day, I think that simplistic notion of more buyers than sellers, more sellers than buyers, I really kind of awakened in me a realization that, why it is causing that is really immaterial to what I'm looking to do here. And so I think a lot of our listeners doing that, like we've always talked about on this show in the past, having that directional sense, I want to buy a call, I think the stock's going to go up and vice versa. The more you can kind of move away from that in your trading, the more you can graduate to that next level. We've talked about many times being more volatility conscious and thinking, well, I think I have a more grandiose volatility view, in which case I don't really care where the underlying moves as long as my volatility or perhaps my gamma view, whatever the case may be, comes into play. So that's, I think, was another realization for me that in order to adjust my mindset from here's the analysis, here's the technical pattern, here's what the analysts are saying, here's the whisper number, it's going to do X, and then it does Y. You try to figure out why, and the more time you spend doing that and trying to figure out where that's going, the less time it gives you to actually analyze your options trade and set them up. And so I think that was an interesting mindset shift for me that kind of went hand in hand with the paper flow analogy, and it was kind of a realization that as a market maker, a lot of this was out of your hands. And the more that you adapted to that and were able to adapt quickly, the better and more successful you would be. I think a retail trader, again, we've talked about this before, you guys are still pretty small fish in this big pond. You're not going to move things. You're not going to drive things. So the more nimble you are, better able you are to react to what's going on in the marketplace, regardless of your viewpoint at it, the better and more effective of an options trader you will be. All right, I got derailed by that, Mr. Passarelli, but it kind of just came to me in a flurry of inspiration after listening to you. So, Mr. P, what else do you have cooking for our listeners? Maybe the inverse or the opposite of the advice you just gave us, or the wisdom you just gave us, was the best advice you heard. What maybe was the worst? What was the most detrimental? What was the advice that really just cost you a lot of money or time, or just kind of had a negative impact on you over time?
Oh boy, you know what? It's always, I guess, sort of the advice that we've all kind of come up with on our own that John kind of touched on a little bit, just sort of the stubbornness and arrogance of thinking that you've got it right, and I would talk to the clerks when I was a trader. When I was down in the Ford Motor Company pit as a market maker, the DPM would hire clerks, and these guys would clerk for the DPM for a year, whatever, and then they'd move them up to trader, and then some of them would make it and some of them wouldn't. And I could always, well, maybe not always, but almost always, tell which of these clerks was going to make it and which wasn't. The ones who ended up being successful were just the ones who observed, didn't have grandiose opinions like you were saying, Mark. They just sat and watched the market, and you'd say, hey, you think the stock is going up or down? They wouldn't have any opinion whatsoever. But every once in a while, like I remember this one time, one of those clerks came up to me and said, hey, Paz, look at this chart of blah, blah, blah company, one of the stocks in our pit. It's like, oh, look at this thing. This thing's definitely going up. Oh, look at this. You should buy some deltas here. And I just like, dude, beat it. Just scram. Like, you are doing nothing except proving you have no idea what you're talking about or no idea what trading's all about. So that's sort of the worst, I guess, thing you could come up with on your own is just doing the opposite of exactly what we're all talking about here, fighting the paper flow and forming opinions and thinking you know something about the market. Because the fact of the matter is, none of us, trading is not really about predicting a market at all. Trading is about reacting to uncertainty and having a plan for that. So
that's a hard thing for a lot of retail traders to come to. They come to it from equities, and usually that's a very directional mindset. I'm going to buy this stock and hold it forever, or I'm going to buy this stock and hold it for X amount of time because I think it has 20% upside in it. And then now you come to options with that same mindset of, hey, I think this is going to do this, and I'm going to construct my positions like that. And it's hard to step back like that and say, wait a minute, I don't really know what's going on here. Or my insight is maybe the opposite of what's going on in this product, or maybe that my insight is kind of immaterial to what actually needs to be done here. So I think taking that step back, it definitely helps you in the long term to really be able to start doing these other things we've been talking about here, like putting on things like calendar spreads and other things like that are a little bit more nuanced, volatility-centric positions that really require you almost to take a step back from yourself and look at the grander picture of the product and be able to execute and adjust. You know, we talk about adjusting a lot on this show. Adjusting is very hard, and adjusting your positions appropriately. And if you have some sort of grandiose mindset for what the product should be doing and it's not doing it, it's going to be hard for you to adjust effectively. So we've been talking about a lot of kind of big picture stuff here, a lot of mindset changes, but I know we want to give you some practical wisdom as well. And Mr. C, I know you're really excited to dive into, I suppose you can call it the misconception, the issue with those upside deltas, and how the deltas really in calls, they may not be all they're cracked up to be.
Yes, when I came down to the floor in 1989, yes, folks, I'm that old, there were really no computers back then, and we had to do all the delta calculations by hand. And then one of the first things I learned was the term called fake deltas. And what that means is that we have gone over this many, many times in our programs, where if you look at Sokol Trade's platform or in another platform, and they give you the Greeks, they'll give you the out-of-money calls, they'll give you a Greek, they'll give you a delta, and that delta might be 10. And then you'll see the stock one day go up $1, and you'll see your calls unchanged. And you'll call into me, or you'll ask Dan or Mark, what happened? We get the call every single day. What happens is that the implied volatility got crushed, or the volatility went down. And we call this fake delta. So what happens is that traders who are hedgers, so most traders will hedge their positions, what they'll do sometimes is they'll take the calls out of the calculation. If they're long a lot of out-of-money calls, they kind of won't pretend they have them. They won't hedge them. A perfect example is I have a position in Zynga. It's a Jan 5 calls. And the stock is up $0.10 today. And coming into today, the delta was a 20 delta, according to my machine here. And these calls should be up 2 cents. Guess what? They're down a penny or unchanged. So what happened? So volatility got crushed. Now, if I had bought these calls and sold stock against them, I would be down money. So just be very careful. Don't be surprised if the delta, the out-of-money calls, if you should definitely, it might be wrong if the stock moves higher, and to, in your head, discount a little bit.
Now, I'm going to take that ball and run with it a little bit, John, because I've been thinking about some upside lessons I learned as well on the trading floor. Now, we talked on a recent show about volatility skew and how that shape really shapes up in most of the products you're going to trade, listeners, which are the equities and equity options. And, of course, that is that investment skew shape where the implied volatility is bid up, there's a premium on the put wing, and deflated in the call wing as a result of all the paper flow we see in these products. Large funds coming in, selling calls to generate income off their equities, and also buying puts to hedge their long equity portfolios. Just the way these products work. So the result of that, and all of that being beaten into our heads and how investment skew works, is we have this presumption, and that John was just illuminating that, and it is correct, 99.9% of the time, when you have those upside movements in these names, that vol is going to come off aggressively, and all these deltas and these upside calls are essentially fake, and you can't really rely on them. But what I did learn from a lot of time, particularly in the indexes, and maybe to a lesser degree in the equities as well, but a lot of you also trade SPY and products like this, so this is relevant to you as well, is that when you have these extended, prolonged moves to the upside, like we've been seeing even of late in the broad indexes, that can also carry with it its own repercussions and its own, in a way, almost like a downside crash. And I've experienced several periods of this where a lot of guys on the floor just refer to this as an upside crash. And I would say, what are you talking about? And we'd walk through the different levels because the skew wasn't performing the way we thought. And what we had was an unexpected and relatively prolonged continuous move to the upside over a number of trading sessions, days, weeks, sometimes even months, or a month or so. And so what we had was this move, and a lot of the crowd was essentially short upside for a variety of reasons. You had been hedging things. You were actively looking to get rid of these calls that you own because of all the expectations you had, the upside calls, the deltas being fake, the implied volatility getting crushed as soon as we started moving that way. And certainly in the initial rounds, as we started taking our short steps up in the beginning, those calls would indeed get crushed. But as we continued moving, perhaps beyond the expectations of people and into a lot of the realms where the crowd was dramatically short a lot of premium, that was where the upside panic started to set in. And we actually saw performance similar to what we see in a big downside movement where the call wing actually started to get bid. And the implied volatility started filtering back into these options. And all of a sudden we had essentially this upside crash scenario where people were scrambling to hedge their upside. And this does happen. It's infrequent, but it does happen. So if you are one of these people out there who does nothing but blast away upside calls and think you're immune to all these things for the reasons that John just laid out, and we've said many times on this show, implied volatility comes out after earnings, the calls go down, and that usually is the case. Just be aware of these types of things and how they could occur, and maybe when you're doing these types of trades, hopefully you've been listening to this show and you're not short a ton of, let's say, naked ratios to the upside or something like that. And if you are going to take that approach, for the love of God, at least maybe have a little bit of a kicker way out there, just in case the worst does come to pass. I know a lot of you have a hard time wrapping your heads around that. Say, why should I waste any of the premium that I'm taking so much risk to harvest on some even more out-of-the-money calls that are even more worthless just to hedge my risk? But I think you'll like that. I think your margin department at your brokerage firm will let you trade a little more because you do that. And at the end of the day, in some of these scenarios where we do experience these upside crashes where all of a sudden you're kind of scrambling to get back those options that you're short, you don't have that same risk profile, that same scenario that a lot of other people do who are just out there blasting away at the upside. So that's one of those practical things I wanted to impart. It does happen infrequently, but it does happen. And so you have this notion of a crash is just to the downside. It can happen on occasion to the upside. And now, speaking of crashes, we're going to crash right into our next bit of wisdom from Signor Passarelli.
So one thing that I think would be interesting really to talk about to everyone is just kind of how trading is different nowadays than it was when Mark and John and myself were down on the trading floor. Man, it is a different world. I talk to retail traders and they say, oh, I'm on this platform, Think or Swim or whatever, but I heard this other one's better. What do you think, Dan? Is it really worth it? Or they'll say things like, oh, my commissions are so high, I'm paying, 2 cents a share for stock, and I'm paying 50 cents a contract here. And let me tell you something. The things that retail traders worry about now is such a gosh darn luxury, because when we're down on the trading floor, I know I was paying commissions in some cases higher than people typically pay in a retail account. I think what's really fundamentally changed is the bid-ask spread. When we were down on the trading floor, me and Mark and John, it was humongously wider than it is right now. Like, that's where we made our money, is buying the bid and selling the offer. And when the bid and the offer are pretty far apart, it's a great way to make money. It was, sometimes it's kind of easy, really. But now it's really a great time to be a retail trader because the bid-ask spread is so tight. Your expenses are so low. And the only thing that really holds anybody back now is just simply knowledge. I mean, the playing field has been virtually leveled, really, by the competitive nature of what's going on in this business, forcing the bid-ask spread tighter and forcing commissions and such lower.
I mean, I hate to keep beating that drum, but I mean, look at what you guys over at Sogo are charging, John. I mean, it's crazy to think, that's commensurate with what some market makers are paying not that long ago. So to see retail, and God forbid you were in a full service account like a Schwab a decade ago, you were paying $40, $50 a ticket, So to see where these prices have come just from a price and access perspective for much better service. I mean, you can execute instantaneously now. Back then it was worked forever, and it was a much, definitely an inferior experience for the end user. So yeah, I just keep coming back to that because you guys are just pricing up a storm over there at Sogo, and I like to point that out because I don't think listeners who haven't been in this business for a long time and haven't seen what commissions used to be, I don't think really have a full appreciation for what goes into that pricing and how difficult it is for you guys to offer that out there. But of course, we have to wrap up this segment of the basic training, but I'll give Mr. C the pride of place here at the end to take us home. And I know, John, a lot of the wisdom and a lot of the effort that goes into options education and lessons learned and things like that are always in the setups. You know, what trade do I put on? How do I put this on? How do I pick X stock or X option? But you take a little bit different approach, that some of the best trades may be actually on the exiting portion of the equation rather than on the entering portion.
Yeah, this is an area that's actually neglected, and I think we spoke about it in some episodes ago. But the best trades are not always the winning ones, but closing the losing ones before they put you out of business. If you want to stay in business and be profitable for a long time, you'll be well served to close your losing positions before they blow you out. You know, it takes discipline. You need to put a mental stop on or a real stop on the trade. But it's very important. I have a real quick story. Back in 1995, I like to trade a lot of takeover candidates. I like to be where the action was. And I was trading Lotus, which was a perennial takeover candidate. And one Friday afternoon, the stock was trading at 32.5. It was actually up $3 that day. And so the rumors were percolating already again. I was short to 35 calls, and they were trading at an eighth of a dollar back then. I was short about 200. Goldman Sachs came in at about 3 o'clock, and I think it was Goldman, and they bought some calls at an eighth. I sold some more. They came back at about 3:30, paid a quarter now. I passed in that trade, bought back my short. I went long. It was absurd volatility, so throw the volatility out the window. Doesn't matter at that price. Monday morning, we all know what happened, or you should know what happened. The stock opened at 61.5, up $29. And buying back these calls and actually going long not only made me a little bit of money, saved me from being out of business after being in the business for only 6 years. There was about 4,000 calls that traded that day, I think, in that strike, and normally about 400 traded. So, again, the bottom line is, take your lumps. If you put a trade on and it's really going against it and you don't know what's going on, just close it out. Rather be safe than sorry. So that's my lesson for the day.
Yeah, we all had a lot of examples of that. Some of these perhaps dubious trades going on right at the close that you didn't want to be on the other side of. Maybe that's a good topic for a show, getting into unusual activity and somehow that could feed back into your options trading. We do a lot of that, obviously, at Options Insider. We had that big event back in May all about that. It might be good to dive into that realm for some of the listeners of this show as well. And speaking of our listeners, it's time to give you guys a voice on the program because it's time for the mail call segment.
Mail call. Time to look at questions submitted by our listeners.
All right, welcome to the mail call segment. If you'd like to make your voices heard with your fellow listeners here, a lot of great ways to do that. Surf on over to theoptionsinsider.com and post your comments on the show notes there, on the articles in the show, and we'll be sure to route them to the appropriate show. Also, you can find us on Twitter, twitter.com/options, Facebook, facebook.com/theoptionsinsider, or the old-fashioned way, questions@theoptionsinsider.com. Just be sure to put the name of the show you're referring to in the subject line, just like some of our listeners did here today, so we can route your question to the appropriate show. Going to kick this off with a timely one. We got this on a lot of our shows on the network over the past week or so, as you might imagine. This question came from George, and George asks, why were puts so expensive when Twitter options launched? A lot of people want to know this one. Obviously, like I said, very timely. And we're recording this, listeners, on November 19th, so we're just a few days away from the big launch of Twitter options back on the 15th, I believe it was. So we have a couple of days in hindsight in the rearview mirror to see how this launched. And as expected, a lot of people looked when the options launched. The puts, as George implies, were bid up. They were very expensive. Now, why is that? Well, you have to look at the underlying stock situation to really understand that. When Twitter launched, it had a very limited float. It wasn't floating a lot of shares. So when the underlying rallied, a lot of people wanted to come in and they wanted to short this stock. Of course, if you have to short a stock, what does your broker have to do? They have to go out and find shares to borrow. That was a very difficult and expensive process. I believe actually in the initial trading days of when the stock launched, the borrow rate was somewhere around 99%. So you were actually paying the full value again for that stock for the privilege of borrowing it. That rate came down in subsequent trading days as more shares became available and more float became accessible to the brokerage firms. But still, it was expensive. And so going into the launch of Twitter options a week later, that cost of borrowing the stock was still very high. And that was what was reflected in the puts. Remember, market makers, they're people too. They can't just magically produce short stock to hedge all the puts that you guys want to buy and they have to sell the stock against. They need to find short stock to sell as well. And so that's a difficult process for them as well. It's an expensive process for them as well. And that cost of borrow that they're paying, that increased cost, is going to be reflected in those puts that you're buying out there. And remember, they see the options listed, they can't borrow the stock. What's their next step? Well, I'm going to buy a put and let the options market let me get short stock that way. So that was the use case a lot of people came to Twitter options for. In fact, the put call ratio is somewhere around 2-to-1 in that opening session. So a lot of people gobbling up puts as expected. So you had the combination of a lot of paper flow bidding up the vol down there, and of course the increased cost of carry that really jacked up those put options. And so as a result, that combination of those two things helped make that put wing very inflated. It has come off in subsequent trading sessions as the demand for those puts has decreased somewhat, and also as the cost of carry has become more in line as the stock has become a little bit easier to borrow. And that was really why we saw those puts getting jacked up to the moon. All right, next up, we have a question from Mr. Niles F. writing to us from scenic Montgomery, Alabama. I think it might be our first listener from that area of Alabama anyway, so welcome, Niles. And he writes, I saw an article recently touting a synthetic covered call strategy that essentially involved buying an in-the-money call and selling an out-of-the-money call against it. It was really just a vertical call spread. What am I missing? How is this a synthetic covered call? Well, this is an interesting question. Gets into some things we talked about many times on this show in the past. Mr. Passarelli, I'm sure you deal a lot with these different types of strategies and how to set up these quote-unquote synthetic other types of strategies using existing options. So why don't you walk our listeners through what this article really is referring to and how this actually is quote-unquote a synthetic covered call strategy.
Sure. Your question here at the end of your question here, you say, what am I missing? Dude, you are missing nothing. This is not a synthetic covered call. It's a position that in some ways has some characteristics that are somewhat similar to a covered call, but it's clearly not a covered call at all. It's clearly not a synthetic covered call at all. A synthetic covered call is a short put. This clearly is just a bull call spread. I don't know what the author was referring to. Hopefully it's nobody I know who wrote this article. But yeah, I think the person maybe didn't know what a bull call spread is called, and so he just made up the name synthetic covered call.
Are you not familiar with marketing speak, sir? It sounds much sexier to say synthetic covered call. You know, I think I know the article this person is referring to, and that did catch my eye as well. I said, wait a minute. Synthetic covered call. A lot of things I might call this. I don't know if synthetic covered call would be one of them. But I kind of see, I think, where he's going with it. I think, I've talked on this show in the past about using a stock replacement strategy as this in lieu of the equity portion of your covered calls trade. So then instead of buying stock, you're buying usually an in-the-money leap. And then you're writing near-term calls. So that's kind of, so I guess you could see if you rolled this forward and had it all essentially same month, and then you're just buying a stock replacement with an in-the-money call and then writing a call that same month. It's analogous to that. It's not really the same thing, but it's maybe I can be charitable and see it in that light.
Yeah, I mean, to be fair, I was being a little saltier than normal.
You salty, I refuse to believe it.
We could actually talk a whole long time about this, but it's only an hour or so podcast. So I have likewise talked to some of my students who are traders who are interested in putting on a covered call for a short period of time. I ask my students, well, why would you want to do that? If you're a trader, why would you put on a covered call, which is an investment strategy? Like investors, in my opinion, investors trade covered calls. Investors who own stocks, and you're looking at the stock that you've owned for 5 years in your portfolio, and you say, oh man, I don't want to sell this, but I don't really think it's going anywhere. How can I make this thing work for me? Well, then you turn into a covered call. That's what covered calls are for. But if you don't have a stock in your position and you think, I think over the next couple of weeks, a covered call would make a lot of sense in this stock. Well, you don't put on a covered call. That's silly. You instead do something like is being described here, a bull call spread where the call you're buying is in the money and it's a high delta and it's somewhat of a proxy. I won't use the word synthetic because to me that has a more very, very specific meaning. But the in the money call can be used as a proxy for buying the stock. And then the call that you sell that's part of that vertical call spread is similar to the call being sold in a covered call position. So, I mean, don't get me wrong. There's a relationship there, and there is definitely some carryover. But, you know, hey, man, being an option trader, you need to be a little creative and kind of think out of the box about some of these. And I think you can use this in the money bull call spread here.
Yeah, I guess he figured if he wrote it up as just a bull call spread, it wouldn't get picked up nearly as much as a synthetic covered call headline article would do. So there we go.
Right.
Interesting article, and I kind of had the same opinion as our listener. So I'm glad someone wrote in about it because it kind of caught my attention as well. And I was kind of thinking of a way to bring it up, and our listeners did it for us, I should say, because you guys are awesome. All right. Before we keep rolling to the next question, Mr. C, I know you have something you want to add on the whole Twitter and why the puts are so expensive.
Well, I want to add a few real quick things. The cost of short has been coming down. I think it's down to 25% right now. Another thing that customers
a bargain. I'll take two, sir.
Yeah, it's a bargain, and we can locate it some right now, some short stock. Another thing is. The naked requirements are 100%. So if the customer thought, well, I'm going to go out there and just going to sell some calls, deep in the money calls, the requirement there is 100%. So you can't do that either. The same thing happened when LinkedIn came out. It had, I think, like an 8 million or a very small float. It was the same thing happened. Actually, the same thing happened for the whole marketplace. If you remember, in 2008 when we had the economic crisis and there was an unprecedented ban on short selling was enacted for a few days. The conversion reversal market became really out of whack, and we saw some puts that were $1 or $2 above fair value as far as conversion reversal goes. So that's a similar case. So, you know, the advice to customers is that when you see that on the first day of trading and you say, boy, this looks out of line. Why are the puts so high? I'm going to do this. Just be careful. The market makers are very smart people. A lot of it's run by computers now. So, you know, you be careful if you think, wow, I'm smarter than these guys. I'm going to do this trade. So there's probably a good reason behind it.
All right, next up here on the mailbag, a lot of listeners seem to be writing in with questions about articles they've been reading. So we like that, listeners. Keep it up. This question actually comes from by way of the Barron's blogs. And someone I think, sent a similar question into the Option Block show as well. So a lot of people picking up on this article as well. A question, let's see. 1 second here. All right. This question comes from Mr. Giff, and he writes, great show on volatility skew. What do you guys think of this piece? Should I, as an investor, avoid these volatility ETFs? And the article he's referring to is an article, like I said, on the Barron's blogs called Volatility Index is Up, ETNs Are Down. What gives? It's an interesting article and written by Brendan Conway. Used to write the options articles over there in the Wall Street Journal, since moved on to Barron's. And this, I guess, came out as a result of their big ETF conference they have going on over there at Barron's. And some of the managers, it seems, on these funds are starting to wake up to something we haven't really addressed too much in this show, but it's very much a factor in a lot of these big index products with the futures options on them. And that is, of course, a roll risk. And essentially, we talked about term structure in the past of an option. Things like the volatility products, particularly VIX and the others, the futures, as we're seeing right now, the nearer-term futures are dramatically cheaper than the longer-term futures. So what you have is a scenario where you have a short-dated product, like in this case, you're talking about VXX, which is that VIX ETF. If you're constantly trading a lot of very near-term products and then rolling them out to farther longer dated contracts, you're paying that roll premium. That's costing you money time and again. Every time you readjust and rebalance, you're paying that roll premium. And what this one particular manager deduced in his analysis was that it was costing him about 14%. You have to make more than 14% per month just to offset that roll risk. So he said, that's a crazy thing. Why would I ever want to own this VXX product? They also made an interesting point here that I thought was kind of interesting for our listeners, that the average holding period on this VXX ETF, which is very popular, and any given day, it's one of the top exchange-traded products by volume. The average investor holding period of that product is 1 day. So keep that in mind when you're trading these products. And we kind of touched on VIX and volatility a little bit on the show. I think we can get into more about the universe of ETPs that surrounds it and how convoluted and dubious it may be. Remember, these ETPs, a lot of them have to rebalance at the end of every day. So essentially, they're resetting to zero at the end of every day. So they're going to underperform just from that function alone. So if you're looking at a lot of these shorter term products like VXX and some of these other VIX and volatility ETPs, and you don't really understand how they work, this is what can come back to bite you. This is the price you will pay, quite literally. If you don't understand roll risk, you don't understand volatility term structure, if you don't understand how these ETFs are rebalanced and how that will impact the performance. There's a lot that goes into trading volatility in and of itself, and even more when you're trying to trade these universe of peripheral volatility products, because they're all built in different ways and they all have different pluses and minuses and nuances that you have to learn. In this case, if you're trading VXX and you're not aware of these different nuances, you're going to cost yourself a lot of money. So I encourage you to check this article out if you haven't, listeners. Volatility index is up, ETNs are down. What gives? Or, of course, you can always surf on over to the Options Insider. We have a lot of material on this sort of stuff. Now, Mr. P, I know a lot of your students are probably active in this product or are interested in trading it. So what do you have to say to them when they come to you looking to trade this stuff? And what's your take in general on this article here?
Well, as this question was originally poised here, he says, should I, as an investor, avoid these volatility ETFs? And the answer is yes. If you are an investor and you're not a professional option trader, you should not trade volatility ETFs. Pure and simple. If you consider yourself an investor, you invest in something. So like if you go and you buy shares of the Ford Motor Company stock, you're investing in this company that sells cars, right? That's kind of tangible, kind of makes a lot of sense. VXX, if you're an investor and you buy shares of this volatility index, what are you investing in? If you can't answer that question, if you have to really sit and think about it and it's kind of foggy, like you don't really know exactly what you're investing in, you have no business even thinking about it. You know, those products were not built for investors. It's not an investment vehicle. So no, as an investor, should you invest in these volatility ETFs? You should absolutely not invest in these volatility ETFs.
Yes, that's kind of the crux of the article there, that they're very, very short-term products. The average holding period 1 day. If you're thinking you can buy and hold them because you have some sort of speculative view on volatility, that is not the best tool for you. A lot of people are still using it for that. So I'm glad to see more in the mainstream, quote-unquote, financial media are actually picking that ball up and running with it, as opposed to just us here beating the drum on a regular basis.
Well, you know, somebody's got to lose money for everybody else to make money.
Exactly. All right, last up. This one's directed squarely at you, John, so I'll let you take a run at it. This is the question from Mr. Buckeye. I guess he's coming to us from Ohio. And he writes, question for John. Can I buy a stock on margin, then write covered calls against it, or does a broker like Sogo remove the 50% margin and make you pay the full price for the stock when you sell the calls? So I guess essentially what he's asking is, you know, everyone knows you can buy stock on margin, 50%. Do you lose that margin advantage? Does your broker kind of make you pay full price for it when you decide to write some options against it, like let's say a covered call on a one-to-one basis? Or do you get to keep your margin treatment, John?
You get to keep your margin treatment. The covered call requirement is the long equity requirement only. So the answer is that we do not remove the margin when you do a covered call. So that's a short answer. And I just want to mention one really quick thing about these volatility ETFs. Let's also include the inverse and leverage ETFs in this discussion. And I'll just say that everything we said about the volatility ETFs applies even 2 times or more to these inverse or leverage ETFs. Avoid them if you can. Only use them for short-term plays.
Yeah, if you can't wrap your head around straight up VXX, then these levered inverse 3x ratio crazy things, you certainly should stay clear of those. So great question, Mr. Buckeye. Great questions, everybody. You guys really bringing your A game this week. We love it. Keep it up. Unfortunately, that's all the time we have for the mailbag segment. It's also all the time we have for this show. But really quick, before we go, let me check in with each of my cohorts, my partners in crime, to see what they have cooking in their respective necks of the woods. Starting off with you, Mr. Passarelli, how goes the land of the elite?
The elitists. The MTM Elite Trader chat room is actually going spectacular. We had a really, really great response day one, launch day, which was the day we recorded the last episode of Bootcamp. And we keep getting new people joining the room every day. And it really, really lived up to the expectations that I had for it, and it's great. I did announce on the Options News Rundown show that I do here on the Options Insider Radio Network. I did announce a special price that I do have for you guys. It's a trial. It's my 2 for 2 trial, 2 weeks for just $2. If you want to get a flavor for what this new chat room is all about. So if you go to markettaker.com/2for2. So that's markettaker.com/2, the word FOR, the number 2, all one word. You'll be able to try out the chat room, kind of try it before you really buy it. 2 weeks for just $2.
$2. All that Chianti wisdom you can get for just $2, listeners, in 2 weeks. That's a good deal. And actually, I'm joking, but I think it would be great to let some of your members in that chat room, to let some of their questions filter onto the show here as well. Obviously, we have a lot of listeners who want to get on too, but maybe once in a while we could squeeze in a chat question from one of your elite folks over there as well. Might be kind of interesting.
Absolutely.
All right, and speaking of elitists, Mr. Critchley, what's cooking in the land of SogoTrade.com, the home of mega cheap, super cheap options commissions?
I'm still working on this this margin, or this reduced commission for closing transactions. It's kind of tricky, the programming, and we're trying to get a matrix done. So we're hoping to have that, sometime soon. No promises. We're trying to get it through. We're also doing some tweaking with our optimizer a little bit. It's a work in progress. So far, so good, no problems. But we're still tweaking that, and we have a screener coming out and a new advanced charting, and we're all at SogoTrade looking forward to the holidays. So see you guys soon.
Great stuff. If you want to learn more, check out that screener and all those other cool tools, as well as the cheap commissions that I keep going on about, because they're pretty crazy. I think John's going on the Crazy John's commission sale over there. Then surf on over to SogoTrade.com and kick the tires for yourself and see if you like what you find there. And on behalf of John and Dan, actually, before we go really quickly, I should mention to you too as well, listeners, if you like to all the stuff we're talking about here on the show and you want to learn more, I'm actually doing an educational event. We're bringing back the Options Insider Educational Series. It's going to be online this time, so you don't have to fly to Chicago. You can check out our kind of options trading overview, our basics, our kind of our primer for all of you guys out there in the options world. Want to learn more about the kind of mistakes you guys make and how to avoid them, as well as how to manage a lot of common options positions that you guys really want to get into and probably make a lot of mistakes when you're managing. So you want to check that out. Surf on over to theoptionsinsider.com/events and register for that today. You can join us from the comfort of your own home in your favorite bunny slippers. So December 7th, we'll look forward to seeing you there, theoptionsinsider.com/events. And on behalf of John and Dan, and of course myself, I want to thank all of you guys in the listening audience for downloading and streaming and subscribing to the show. And of course, for sending in such great questions. Keep them up. We love it. And we'll see you guys next time right here on Options Bootcamp.
Options Bootcamp is brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.